There's this one single number that can literally decide whether you can afford to buy a house, how fast your savings will grow, and even the health of the entire global economy. So today, we're going to break down that number, the interest rate.
All right, here's what we've got on tap. We're going to start with the absolute core concept, then get into the two different ways it's calculated. From there, we'll see how it all plays out in the real world, what the economic levers are, and even touch on a really important question of fairness. And then we'll wrap it all up with why this matters, directly to you. Sound good? Let's dive in. All right, first things first, let's get right down to the most fundamental idea. Before we get into all the complicated stuff, we've got to be on the same page. So, what exactly is an interest rate?
Okay, super simple. At its core, an interest rate is just the price of using someone else's money. The easiest way to think about it, it's like paying rent, but for cash, right? So if you take out a loan for a house or a car, you're basically renting a big pile of money. And that interest rate, well, that's the rental fee you're paying.
But here's where it gets really interesting. This whole price of money thing, it's a two-way street. When you borrow, yeah, it's a cost you have to pay. But when you save money in a bank, the tables are turned. You're actually the one doing the lending, and the bank pays you interest as a fee for using your money. It completely depends on which side of the deal you're on.
Okay, so we've got the what, but what about the how? How is this stuff actually calculated? And you really want to pay attention here, because the method they use can literally cost you or make you an absolute fortune. So there are really two main ways this gets done, and the difference between them is, well, it's massive. First, you've got simple interest, and it's exactly what it sounds like. Simple. It's just a fixed percentage of the original amount you borrowed. That's it. But then there's compound interest. And folks, this is where the magic or the pain really happens. See, it calculates interest not just on the principal, but on the interest you've already racked up. It's literally interest on interest. Let's put some real numbers on this. Imagine a $300,000 loan, 30 years at a 4% rate, okay? Now, if it was simple interest, the math is pretty straightforward. You'd end up paying about $360,000 in interest over the life of the loan. But here's the kicker. Almost no loan in the real world is simple interest. With monthly compounding, that same loan's interest payment skyrockets to over $673,000. I mean, think about that. You're paying back almost $1 million for a $300,000 house. Yeah, that is a difference of more than $313,000. Just let that number sink in for a second. It's the same loan amount, the same interest rate, the same time period. The only thing that changed was the calculation method. This, right here, is why you've got to read the fine print. Knowing if your interest is simple or compound, it's a huge, huge deal for your wallet. All right, let's switch gears a bit and talk about how you actually see these rates out in the wild. You've probably seen these acronyms floating around, APR and APY. And no, they are not the same thing, not even close. And knowing the difference is absolutely key. So here's the easiest way to keep them straight in your head. APR, that's for when you're borrowing. Think annual percentage rate. That's the rate on your credit card or your car loan. APY, on the other hand, is for earning. Think annual percentage yield. That's what you get on your savings account. And the really important part is that APY takes compounding into account. That's why it gives you a much more accurate picture of what you'll actually earn in a year, and it's also why it's almost always a little bit higher than the stated interest rate. So a big question is, who actually sets these rates? Where do they come from? Well, it's definitely not random. In fact, interest rates are one of the most powerful tools that central banks use to steer a country's entire economy. And it's not just one person flipping a switch. You've got to think of it in layers. Way up at the top, you've got the central bank. In the US, that's the Federal Reserve, or the Fed. They set the big benchmark rate, and their decision is based on how the whole economy's doing. Stuff like inflation and economic growth. But the final rate that you get offered, that comes down to your personal situation. Your financial health, which is pretty much summed up by your credit score, is a massive factor for any lender.
A good way to picture this is to think of interest rates as the gas and the brake pedals for the economy. So when the Fed raises rates, it's like they're tapping the brakes. It gets more expensive for big banks to borrow money. And guess what? They pass that cost right on down to us. Mortgages, car loans, credit cards, they all get more expensive. So people borrow less, they spend less, and the economy starts to cool down. And when they lower rates, it's the exact opposite. It's like hitting the gas. Borrowing gets cheaper, and that encourages everyone to spend more, which helps the economy grow.
And you can see this playing out in real time. Just look at mortgage rates. A number like this one, it's just a snapshot, right? The average rate for a 30-year mortgage at one specific moment. But that number is never sitting still. It's constantly moving up and down, and it's a direct reflection of what the central bank is doing and how the overall market is reacting. But, the story of interest rates isn't just about economics. It gets into some really deep social issues, too. I mean, in a perfect world, your ability to get a loan would just be about your finances, plain and simple. But when you actually start digging into the data, you find that's not always what's happening. You start to see some really troubling patterns. So take a look at this. This is 2023 data from the Home Mortgage Disclosure Act. It shows that the chances of getting denied for a standard mortgage are really different depending on your race. Black applicants were denied about 17% of the time. Now compare that to white applicants, who were denied less than 7% of the time. That's more than 2.5 times higher, a huge difference. And this isn't just about getting approved or denied. For the people who do get approved, other research points to a very real financial cost. Multiple studies have found that, on average, Black homeowners often pay higher interest rates. We're talking about something that can add up to hundreds of extra dollars in payments year after year. Now, to be clear, this is a really complex topic, and there are different ways to interpret this data. For example, a 2022 study from economists at the Fed suggested that this gap might not be about discrimination. Instead, it could be about different financial choices people make. They argued that some borrowers might actually choose a loan with a higher interest rate if it means they have to bring less cash to the table for upfront costs. It just goes to show you how tricky it can be to nail down the exact reason for these kinds of disparities. Okay, so we've talked theory, we've talked big picture economics, and even the social side of things. But let's bring this all back home. What does all this actually mean for you and your wallet? Let's get really practical here, because once you understand how the game is played, you can start making it work for you. So here's a question I bet a lot of you have had. Why is the interest rate on a 30-year loan always higher than on a 15-year loan? The answer really pulls back the curtain on how a lender thinks, and it all comes down to two things: risk and time. Just try to put yourself in the bank's shoes for a minute. A 30-year loan is, well, it's twice as long as a 15-year one. That's double the amount of time for something to go wrong, for a borrower to lose their job, have a medical emergency, you name it. That's a lot more risk for the bank. But it's not just that. There's also something called opportunity cost. For 30 years, their money is tied up with you. They can't use it for anything else. So to compensate for both that extra risk and that lost opportunity, what do? They charge you a higher rate. It's kind of like their insurance policy. So what's the most important thing to take away from all this? It's that you actually have some control here. The rate a bank offers you isn't just some fixed number from the sky. So the real question is, how can you put yourself in the best possible position to get the lowest rates? So what are the levers you can actually pull? Well, the single biggest one, without a doubt, is your credit score. That number is the main signal you send to a lender about how much of a risk you are. The higher the score, the lower the rate. Simple as that. But that's not all. You can also choose a shorter loan term, like we just talked about. You can make a bigger down payment. And this one is so important, you have to shop around. Please never just take the first offer you get. Taking the time to compare different lenders can literally save you thousands or even tens of thousands of dollars. So when you step back and look at it, the interest rate is so much more than just a number on a piece of paper. It starts as a simple calculation, but it becomes this massive lever that can move the entire economy. It really is the price of money. It dictates what our dreams cost and how fast our savings can grow. And that leaves us with a final, really important thought to chew on. If this is the price of money, what happens when that price is basically zero for years and years and then all of a sudden it isn't? In a world like that, how do we make sure we're ready not just to survive the changes, but to actually come out ahead?